In 1949, a man wrote a book that would change investing forever. His name was Benjamin Graham, and his student, Warren Buffett, called it the best book on investing ever written. This book teaches you something Wall Street doesn't want you to know, that you don't need to be a genius to be a successful investor. You don't need insider information. You don't need to predict the market. You don't even need to spend hours analyzing stocks. What you need is intelligence. Not intelligence quotient, but emotional intelligence, discipline, and a proven framework. This is the intelligent investor. Graham's first lesson is the most important one. You must know the difference between investing and speculating. A speculator is someone who tries to profit from market fluctuations. They're obsessed with price movements. They check stocks constantly. They react to news headlines. They believe they can predict what the market will do next. An investor is fundamentally different. An investor analyzes a business, studies its fundamentals, determines its intrinsic value, and buys it at a price that provides a margin of safety. Graham said, "The investor's chief problem, and even his worst enemy, is likely to be himself." The market doesn't defeat you. Your emotions do. Your impatience, your greed, your fear. Know what you are. An investor, not a speculator. Graham created one of the most brilliant metaphors in investing history. Mr. Market. Imagine you own a business with a partner named Mr. Market. Every single day, Mr. Market offers to buy your share of the business or sell you his share. Sometimes he's euphoric. The business is worth a fortune. He quotes you a ridiculously high price. Other times he's depressed. The business is worthless. He'll sell you his share for almost nothing. Here's the key. Mr. Market doesn't determine the value of your business. The business's fundamentals do. You don't have to accept his offers. You can ignore him completely, or you can take advantage of him when he's being irrational. When everyone is pessimistic and prices are low, buy. When everyone is euphoric and prices are absurd, sell. Or simply do nothing. The stock market is there to serve you, not to instruct you. Graham's most important concept is the margin of safety. This is the cornerstone of intelligent investing. Here's how it works. Let's say you analyze a business and determine it's worth $100 per share. That's its intrinsic value, what the business is actually worth based on its assets, earnings, and future prospects. But you don't buy it at $100. You wait. You wait until Mr. Market offers it to you for $60, or $50, or $40. That discount, that buffer, is your margin of safety. Why is this so important? Because you might be wrong. Your analysis might be off. The business might face unexpected challenges. The economy might deteriorate. But if you bought with a significant margin of safety, you're protected. Graham said, The margin of safety is always dependent on the price paid. A great company at an absurd price, bad investment. A mediocre company at a bargain price could be a good investment. Price is what you pay. Value is what you get. The difference is your protection. Graham identified two types of investors. The first is the defensive investor. This investor doesn't want to spend much time on investing. They want adequate returns with minimal effort and minimal risk. Graham's advice for the defensive investor is beautifully simple. Number 1, diversify. Own a basket of stocks. Don't put all your eggs in one basket. Number 2, buy quality. Large, established, financially sound companies. Companies with a history of dividend payments. Number 3, don't overpay. Buy when the price is reasonable relative to earnings. And number 4, allocate between stocks and bonds. Graham recommended never less than 25% in bonds and never less than 25% in stocks. Adjust based on market conditions. The defensive investor accepts market returns. They don't try to beat the market, and that's perfectly fine. Over time, market returns compound into significant wealth. Graham dedicated significant attention to the dangers of speculation. Speculation isn't investing, it's gambling. He identified the warning signs. Buying stocks based on tips, following hot trends, chasing performance, trading frequently, using borrowed money, day trading, penny stocks, companies with no earnings, story stocks with exciting narratives but no fundamentals. All speculation, Graham said. The speculator's primary interest lies in anticipating and profiting from market fluctuations. The problem: nobody can consistently predict market fluctuations. Not professionals, not analysts, not you. In the short term, the market is a voting machine. Popularity decides prices, but in the long term, it's a weighing machine. Fundamentals determine value. Speculators focus on the voting. Investors focus on the weighing. Which one are you? Let's review Graham's core principles. Rule 1. Think long term. You're buying a piece of a business, not a lottery ticket. Rule 2. Demand a margin of safety. Never pay full price. Wait for the discount. Rule 3. Be patient. The right opportunities come to those who wait. Rule 4. Control your emotions. Fear and greed are the investor's enemies. Rule 5. Do your homework. Analysis protects you from foolishness. Rule 6. Diversify. Don't bet everything on one outcome. And Rule 7. Ignore Mr. Market's moods. Use them to your advantage. Don't let them control you. These principles have worked for 75 years. They'll work for 75 more. Because human nature doesn't change. Warren Buffett said he's 85% Benjamin Graham. The richest investor in history credits this one book. Why? Because Graham didn't teach tricks, he taught principles. You don't need to be brilliant to be an intelligent investor. You need to be rational when others are emotional. You need to be patient when others are impulsive. You need to focus on value when others chase prices. The market will offer you extraordinary opportunities, but only if you're prepared to wait. Only if you have the discipline to act when everyone else is paralyzed by fear. That's intelligent investing, not complex algorithms, not insider secrets, not market timing, just discipline, analysis, patience, and a margin of safety. Are you ready to become an intelligent investor? The principles are simple. The execution requires discipline, but the rewards can last a lifetime.